Benjamin Graham is credited as the founder of value investing. He released Security Analysis in 1934, and it continues to be one of the key books on value investing. Warren Buffett, arguably the wealthiest and most well-known investor in the world, learnt value investing directly from Benjamin Graham. Here, we share with you many of the learnings that sum up Benjamin Graham's philosophy of value investing and the methodology we use to choose the best deep value stocks. Benjamin Graham on the skill of investing. Benjamin Graham points up something crucial in the introduction to The Intelligent Investor. Even though they possessed a deep understanding of economics, accounting, and stock market lore, we have seen ordinary people make and keep significantly more money than those who had this behavioral trait. This is where Graham was right on target. The best stock market expertise does not distinguish the most successful investors from the rest. They don't possess any secret knowledge either. Benjamin Graham's philosophy of the stock market. Following is how Benjamin Graham perceived the stock market. Prices differ from their underlying values in the short run because markets can be irrational. We are able to locate inexpensive stocks because of this. Stock prices will eventually reflect the company's fundamentals. As a result, we can anticipate that over time, cheap equities will rise to their genuine worth. Its performance is mostly attributable to the stock market's short-term versus long-term behavior. You can only discover inexpensive stocks and sell them for a profit if they follow the pattern of short-term irrationality and long-term convergence to underlying values. Graham used a quantitative approach to the stock market. The financial statements of a corporation are analyzed before choosing stocks, in this case. Benjamin Graham's approach to value investing. Now let's look more closely at what value investing according to Benjamin Graham was. 3 qualities of a good value investing process. In an interview from 1976, Benjamin Graham describes his early approach to value investing. In the conversation, Benjamin Graham described an investing strategy that he had been back-testing for more than 50 years. According to him, the approach trounced every other known value investing approach because of 3 virtues: sound logic, simplicity of application, extraordinarily good performance record. That's Benjamin Graham's own lesson from later in life, favoring a few techniques and simple principles over detailed analysis. Following the market's lead. Is it possible to forecast the stock market's behavior for the upcoming year? Can we determine this and then choose to have the most exposure to stocks or cash? Here is what Benjamin Graham said in a well-known speech he gave on it in 1963. The investor must work extremely hard to have more money invested in common stocks at lower market levels than at what he views as potentially high ones. Historically speaking, he advises investing as much money as possible in stocks, and switching to bonds when prices rise. Picking cheap stocks and following a portfolio approach. Benjamin Graham's value investing strategy focused on finding companies that were undervalued in terms of individual stocks. Attractive valuations use book value to market capitalization or price-to-earnings ratios based on a company's financial filings to identify value stocks. In particular, keep an eye out for businesses that are undervaluing their books or businesses with low P/E ratios. These stocks are offered at tempting prices. Using the discounted cash flow (DCF) approach to value a stock is one way to approach the idea of values. The company's intrinsic value is the only value that results. To assess the stock's suitability as an investment, its value is contrasted with the market price. Stocks present an investing opportunity when their intrinsic worth exceeds their market price. The investment opportunity is more appealing the larger the discount from intrinsic value. In contrast, a stock is considered to be highly priced and need to be avoided if its intrinsic value is less than its present market price. Benjamin Graham advanced this intrinsic value strategy even further. Portfolio of stocks. Next is to build a portfolio of the companies that meet the criteria of a value stock. The importance of building a portfolio is to diversify against the risk of any individual stock losing a lot of money. Temperament to hold for the long term. The last step, once we've built a portfolio, is to hold it for the long term. The goal is to sell companies once they reach their intrinsic values. Benjamin Graham's twist to the buy and hold approach. In the majority of value investors' cognitive processes, buy and hold takes up permanent residence. However, it required none other than Benjamin Graham's supreme mind to challenge this notion's core tenets. In a recent interview, Benjamin Graham advocated a different approach from buy and hold. The sage advised, stocks frequently rise and fall together, regardless of the sector they belong to. As a result, your plan should coincide with their peaks and valleys. In other words, you should take maximum exposure to stocks when they are attractively valued and minimize your exposure when they turn expensive. If you liked the video, smash the like button. See you in the next video.